When global powers move, timing is never accidental. The recent U.S. action against Venezuela didn't happen in a vacuum, and it didn't happen because of a sudden change in policy. It happened now, at a very specific moment, when global energy markets are tight, geopolitical alliances are shifting, and election pressure is quietly building inside Washington. These moves always arrive wrapped in official explanations, but history shows that the real reasons live beneath the surface. Tonight, we're not reacting emotionally or politically. We're analyzing timing, incentives, and consequences. Why Venezuela? Why now? And why does this moment matter? Not just for geopolitics, but for commodities like silver and gold, which have historically reacted to conflict long before the headlines admit what's coming. When power moves early, markets listen first and speak later. Welcome back to Boring Silver Mystery, the channel where quiet geopolitical shifts explain loud market reactions. The United States' sudden escalation involving Venezuela has raised eyebrows globally, not because Venezuela is new to sanctions or pressure, but because of the timing. This video is not about headlines or partisan debate. It's about strategic decision-making. We're going to break down why this move happened now, what pressures may have forced Washington's hand, and how election year dynamics often influence foreign policy decisions more than the public realizes. We'll also examine how geopolitical conflict historically reshapes investor behavior, especially toward gold and silver, which tend to react before official narratives catch up. This is about patterns, not propaganda. The most important question isn't what happened, it's when it happened. Venezuela has been under U.S. pressure for years, so a sudden escalation suggests a change in strategic urgency. Timing often reflects external stress rather than internal motivation. Global energy markets are under strain, supply chains remain fragile, and U.S. foreign policy is balancing multiple conflicts simultaneously. Acting now signals that waiting was no longer acceptable. Historically, when a superpower accelerates action during a period of global instability, it's because delaying increases future costs. Venezuela's timing suggests that U.S. policymakers saw a narrowing window where leverage was strongest and consequences were manageable. This is rarely about punishment, it's about positioning. Venezuela holds some of the largest proven oil reserves in the world. Even if production capacity is limited, the resource itself represents long-term strategic value. As global energy markets tighten and geopolitical rivals consolidate supply chains, controller influence over energy-rich regions becomes critical. The U.S. move signals concern over who might benefit from Venezuela's resources if Washington doesn't assert pressure now. Energy isn't just fuel, it's leverage, and leverage matters more when global alliances are shifting. This move may be less about Venezuela itself and more about preventing competitors from gaining strategic footholds during a period of global realignment. Behind every visible action lies a network of invisible pressures. Venezuela's growing diplomatic and economic ties with non-Western powers likely accelerated U.S. urgency. When rival blocs expand influence in the Western Hemisphere, Washington traditionally responds quickly. This isn't Cold War nostalgia, it's strategic continuity. The concern isn't immediate threat, but long-term erosion of influence. Allowing alternative financial systems, energy partnerships, or military cooperation to deepen unchecked would weaken U.S. negotiating power globally. Acting now limits future complexity. This is not about escalation, it's about containment. Election years distort decision-making. Leaders are incentivized to appear decisive, strong, and proactive on national security. Foreign policy actions often increase during election cycles because they project control and distract from domestic economic pressure. Venezuela presents a politically low-risk target compared to larger powers. Action can be framed as defending democracy or stability without triggering large-scale retaliation. History shows that election year foreign policy moves are rarely accidental. They are calculated to resonate with voters while minimizing immediate backlash. This timing fits that pattern precisely. Financial markets rarely wait for official explanations. The moment geopolitical risk rises, capital begins repositioning. Investors don't ask who is right. They ask what is exposed. Historically, war or escalation increases uncertainty, and uncertainty shifts capital toward perceived stores of value. This is where gold and silver quietly re-enter the conversation. Even before conflict escalates, hedging behavior begins. This isn't panic, it's preparation. Markets price risk faster than governments admit it exists. Gold has always functioned as a hedge against geopolitical instability. When war risk increases, currency confidence weakens, especially in regions tied to conflict or trade disruption. Gold benefits not because it produces income, but because it preserves purchasing power when trust erodes. Historically, gold rises not during war announcements, but during prolonged uncertainty. The Venezuela situation adds another layer of instability to an already fragile global system. Even limited conflict increases demand for neutral assets that sit outside political control. Silver behaves differently from gold during conflict. While it shares monetary qualities, it is also an industrial metal. War can disrupt industrial demand while simultaneously increasing investment demand. The result is volatility rather than simple appreciation. However, prolonged geopolitical tension often leads to supply disruptions, currency debasement, and increased physical demand. Silver tends to lag initially and then surge when monetary factors outweigh industrial concerns. Historically, silver's biggest moves come after the market fully understands the scope of instability. Wars are expensive, even limited ones. Funding military actions increases fiscal pressure, especially during periods of high debt. When debt expands faster than economic growth, currencies weaken structurally. This environment benefits hard assets over paper promises. Venezuela's situation may not trigger immediate currency collapse, but it contributes to long-term stress in an already leveraged global system. Investors watching these trends don't wait for confirmation, they position early. This move is symbolic. It signals that geopolitical competition is intensifying and that spheres of influence are being actively defended. Venezuela is one chapter in a broader story of global fragmentation. When global order becomes less predictable, centralized pricing mechanisms, currencies, and markets become more fragile. This environment historically favors decentralization of assets, supply chains, and financial protection strategies. The real impact won't be immediate headlines, but gradual shifts. Increased defense spending, tighter energy markets, higher geopolitical risk premiums, and cautious capital flows. Precious metals won't react overnight, but they will react structurally. Investors who understand timing recognize that war doesn't change markets instantly. It changes expectations, and expectations drive capital. This moment is about recognizing direction, not predicting dates. The U.S. move against Venezuela wasn't random, emotional, or sudden. It was timed, strategic, and deeply connected to global pressure points. When geopolitical tension rises during an election year, markets take note of it if politicians downplay it. If you want to understand geopolitics beyond headlines and how global conflict quietly reshapes markets, you're in the right place. Subscribe to Boring Silver Mystery, stay analytical, and remember markets don't wait for permission to react. They move when power shifts.